Hello traders, this is John Kicklighter, Chief Strategist for DailyFX.com, here to give your FX market wrap-up for the past 24 hours of trading and an outlook for what we can expect in the 24 hours ahead. We opened up this week to some exceptional volatility and it was aimed all at the same place. Generally, risk aversion was taking a lot of these benchmark assets down, including the S&P 500, the yen crosses, and many of the riskier currency crosses, including some of the dollar-based pairs. But this past session, Tuesday, was notably a day of moderation. Right? This has put a lot of people on edge and questioning their bearings, whether they're bullish or bearish. Is this a pullback that has reached its terminal point and is thereby going to return to its prevailing trend? Or is this merely a brief pause before we continue on to a much more significant decline? This is a big question, and of course we don't know the clear answer, but we can definitely talk in terms of probabilities. So in referencing that big decline that we had on Monday, we were looking at the S&P 500 here in terms of notable corrections. We have seen 2+% declines a number of times going back over the past few years. Now, as it has happened, we've seen these kind of corrections have stood out pretty substantially as ending moves. The exhaustion point of corrections that subsequently call an end to the pullback and subsequently have re-engaged the bigger bull trend. Right? That's something that we've seen consistently, and generally that's exactly what you would expect when you're talking about a bigger bull market. So when we look at the S&P 500 over its 5-year bull trend, you can see that we've had a very consistent bearing. All right, so pullbacks are expected in these kind of circumstances. The question that we need to ask is this time different? All right, you hear that a lot, especially in the finance world. Is this time different? All right. Now we look at the correction that we have now, and to the peak to trough move that we've had in this correction, it was nearly a 6% pullback. So you can see the measure of that pullback here in the S&P 500. A 5% plus correction is a noteworthy correction. It's one we should sit up and take notice. All right, but 10%, 15%, those are the much more severe pullbacks that we typically look for, that are the one step away from bear territory. All right, 20+% is when we start to get into a bear market. That's when most outfits would consider it to be a clear bearish signal. So we have a long way to go before we get to 20%. All right. In terms of probabilities, it's best to follow what the larger trend is. And the larger trend is still pointing upwards. We have certainly pulled back within this larger trend, but there is greater consideration for a confirmed reversal in risk trends that we see now than what we've seen in the past. Now, I actually spoke about the difference between corrections or pullbacks versus true reversals and trend change in today's strategy video. Check that out. I run through some of the factors that I look for, and we take special note of the S&P 500 as well as a couple other currency pairs that are very important in this assessment. But I think that even though the probabilities are higher for a continuation of the bear trend, simply through what we are seeing in the technicals, the fundamentals paint a much different picture. We have fundamentals that are substantially changing, and the most important aspect of the fundamental assessment between a correction and a reversal is whether that drive behind this charge, this persistent bearing, is changing. All right? Because when we look at the fundamentals behind this S&P 500 rally, it's the same general circumstances for what is rallying the yen crosses. It is the same general circumstance for what has, until recently, driven the emerging markets and high yield assets. All of these different measures that fit into the risk column, all right, on that same bearing. And that is the presumption of low volatility or low risk, right? Risk that you and I or individual investors would have to take onto our own shoulders, assuming that it's being passed on to a super entity, and an entity outside of the game itself, and that is typically central banks. All right, that is the presumption. that there's going to be exceptionally low levels of risk or volatility, as we usually use as our benchmark for risk, and then subsequently we are let to do what we need in order to compensate for the exceptionally low levels of return that these markets actually offer us. Here is a global assessment of market yield, and you can see that we are well off the pace that we are expecting to see from the S&P 500. And we're able to chase exceptionally low levels of risk because of the assumption of low volatility. How do we do that? Well, we go into those riskier assets, and at the same time we use leverage. All right, so leverage and riskier assets is not something that many traders are willing to do. They consider it to be too risky. So we have in turn a exceptionally low level of participation. All right. In fact, when we look at participation figures, we know that participation, and this is a measure of volume, all right, on the S&P 500 here, is at a 15-year low. So these are the background circumstances for this. Right? The presumption first is that there is going to be an ongoing period of low volatility. People don't assume that they have to accept many risks, and thereby they can search out and try to use finance to their own benefit and try to amplify their gains. All right? They try to amplify their gains through leverage, and that's market circumstances, leveraged positions, record highs, and exceptionally low participation. Those are important aspects of market conditions. All right? It sets the backdrop up to a risky backdrop, a backdrop where the market is certainly exposed to substantial corrections. And these are the circumstances that actually see volatile corrections, disruptive and destructive corrections, because they, once we start to see what happens with leveraged losses on low participation, all right, those are the kind of declines, those are the kind of unwinding positions that lead to a lot of volatility. All right, and as we know, volatility is what we are trying to avoid. Volatility will further expel the participants from the market and kick out those long, ardent bulls. So we are seeing this change in expectations. All right, we're seeing the change for what has been the underlying source of this low volatility circumstance, these expectations, stimulus. All right, global stimulus versus the VIX. I mentioned the stimulus reading or global reading or Fed reading, doesn't matter, constantly. And the presumption is that since I put the stimulus measure versus the S&P 500, like we do with the VIX, since I put the stimulus next to the S&P 500, people think that, oh, stimulus must go directly in the S&P 500. It doesn't. Stimulus has the effect of reducing expectations of individual risk. Thereby, people take something that's more risky. What's more risky? The S&P 500. That's the greater rate of return, greater probability of return. So people chase these down. They also chase down higher returns in the FX market. And that's why we've seen the emerging markets do well until the recent couple months because of changes in monetary policy. The yen crosses were doing exceptionally well in their persistent advance, specifically because of interest rate expectations. All right. The Fed was there. They were encouraged to chase down a higher return, knowing the Bank of Japan was going to devalue their currency. Why not follow that risk-on drive? Now, the thing about the yen crosses is that they are traditionally carry trades. Is this a good time to actually chase down carry trades? Absolutely not. All right? We know carry trade, and that yield I just showed you, is exceptionally low. People had to use leverage, and they had to really ride or front run a central bank's efforts to make something meaningful in terms of return out of that position. So this is the kind of unstable fundamental backdrop we are looking at. So when you look at something like this S&P 500 pullback to this next trend line, all right, or you look at the, euro yen. All right, this is actually an hourly chart of the euro yen, but we can zoom out just as much. We see this pullback to trend line for the euro yen, or the pullback to trend line for the pound yen. All right, all the yen crosses are in the same kind of conditions. You can also look at pairs like even the Aussie dollar. It's had a recent bounce because of the slightly improved outlook for the Australian dollar and its interest rate forecast. When we look at the recent rebound in the emerging market currencies, this is the dollar ZAR. The ZAR had a bounce. We're back to this trend line. All right. You can even look at pound dollar. All right. Back to this now support level. Looks like it could turn into a head and shoulders pattern. You look at these levels, and the question of a pullback versus a continued crash through these levels of support, we have to weigh what the potential is. Now, potential is not necessarily the same thing as probability. As I said with the S&P 500, probability is probably best served to the upside. Doesn't necessarily mean that the returns are the greatest on the upside. If we crash through this floor on the S&P 500, if we crash through the floor on the yen crosses, and I would call it 100 on the dollar yen, but they're a little bit more immediate on the other yen crosses, particularly euro pound and pound yen, we are going to have a much wider range of declines that can actually evolve from that technical development. Why? Because the fundamentals and the market conditions would be supportive of that break to the downside. There would be a lot more room for adjustment because the market conditions have already shown that investors are running on something along the lines of irrational exuberance. All right, but markets can remain irrational longer than we can remain solvent. That's the famous economics line, and really it's financial markets line. But though they can remain irrational longer than most of us can ride or try to fight the trend, eventually it does fall apart. Right? And when it does fall apart, there's a lot more potential in that unwinding, especially if it becomes such a one-sided market, which it has. Now, in terms of what we will be watching in the coming session, I think that the most important aspect, and the whole reason we started with this, is that we have to watch these levels. And we can watch these various measures of risk trends, but I think the S&P 500 is a great benchmark for really the broader risk spectrum. Now, we've talked a number of times, and we will continue to talk about this, the depth of risk trends. When we are talking about a more severe risk aversion theme, as the risk aversion intensity grows, the market impact grows. And then we see that more of the markets are suffering, that capital flow becomes more aggressive, that there is less differentiation between higher yielding assets or lower yielding assets. People just give up about yield altogether. All they care about is liquidity. All right, that's what happens at this extreme. Down here, we can be very picky about what kind of asset we're dumping because it's risky. We'll go to another risky asset, quote unquote, because we can actually get a rate of return. We're going to be competitive with that rate of return. The more severe the risk aversion, the greater the impact on the capital flows, the more desperate they become. And the more desperate they become, the clearer our markets are. The same thing is also true on the opposite side. When people are just seeking out any kind of rate of return, they cut all safe havens. They don't care about safe havens. All they want is rate of return. And they're going to plow capital into all those higher yielding assets. But we're on the opposite of this curve right now. This is where the risk lies, especially considering that we're just off record highs on benchmarks like the S&P 500. Now, we have to keep watching the levels of these assets. Emerging markets is very sensitive. All right, we can watch the benchmark capital markets. We watch the yen crosses. Those two fall into this midline category. And then, of course, when things get very severe, we start to see funding pressures. We can see that in the cash markets in Europe and in the U.S. They're the largest, and they ultimately become the best benchmark or baseline for that. And then we can also look at sovereign bonds and treasury yields, also great measures of that more extreme pressure on sentiment. So as we keep an eye on risk trends, are there any catalysts that we should be looking forward to? Well, we have a couple of catalysts that might pop up on most traders' radars. Indonesia GDP, most of us wouldn't normally look at it, but it's an emerging market catalyst. We didn't have the Philippines central bank rate decision. It was pushed back 2 days. That's going to come up actually on the 6th, so keep an eye on that. Aside from that event risk, traders will also be watching this. This is a good lead-in to the non-farm payrolls due on Friday, the U.S. employment ADP figures, and we will use it as kind of a benchmark. Remember, the Fed's taper is a big change in monetary policy, especially now. This is why this is probably having the greater impact on risk trends. The Fed taper alone might not be a problem, but the fact that the Bank of Japan is not touting or trumpeting any further stimulus program, that the Bank of England is expected to hike rates, and that the ECB is holding back from any other LTRO-like programs, it means that net stimulus is actually being reduced. All right, not actually declining in size and scope, but really in its pace of growth. Right? So this is going to be an important measure because it taps into the taper speculation. We should also watch the ISM service sector report because this is also a fantastic measure of a very important economic sector in the United States, which also accounts for most jobs in the U.S. And of course, we'll keep the close eye on these policy officials who will be speaking as well. Things get much more interactive on Thursday with the BOE rate decision and the ECB rate decision. We'll be covering those a little bit more in depth, especially because I am still very interested in the euro dollar to the short side. I still have the second half of my short position. And the pound dollar, I am waiting for this to be an active trade. It has seen a hold at the 62.50 level. I'd like to see a little bit more of a bounce before it showed continuation, but it needs one or two things. It needs risk aversion, enough so that the dollar really starts to perform. And you have to be careful because the dollar's at the bottom of its rising channel when you look at the FXCM Dow Jones Dollar Index. Or we can see the interest rate expectation for the British pound start to fall apart. If that's the case, there's some great opportunity, not just from the likes of the pound dollar, but I think the pound dollar would be my preferred option. But we can also see other setups like the pound Aussie. Now, and pound yen. You have to definitely put the pound yen in that category. But what happens if the pound does hold up? And what if its circumstances don't really devolve? I really like this pound kiwi. We were talking about this being a short. I actually took this in Friday, but I got stopped out on that spike. Well, as I've found a few times so far this year, setting tight stops is not necessarily the best thing to do because I got stopped out right before it made a massive move to the downside. Played out perfectly in those technicals, but if it gets down to the floor of this channel, or this wedge, I like to play it on the opposite side as long as the fundamental circumstances support it. You can also look at pairs like Euro Pound, which after this bounce has good scope to gain against the Euro. The euro, which is a troubled currency individually, especially if the ECB offers us some kind of speculation that they're going to up the stimulus program at their next rate decision, or in further rate decisions, as we have their rate decision on Thursday. But we'll go more into that detail later on. The last currency I want to show you is the Kiwi. We did see the pound Kiwi make an impressive move this past session. All right, big drop on the pound Kiwi. The Kiwi yen had a massive rally. In fact, it was one of the biggest rallies, 2.2% plus. And that was the biggest pickup that we've seen in a number of months. This is not necessarily just an exhaustion point. We often see big moves are exhaustion points. They are the end of drives. Well, the last time we had a big move of this magnitude, it was actually the beginning of this September run that we had here. So apples to apples. Keep an eye on this, but this is very dependent upon risk trends. A less risk-dependent currency pair is going to be the Aussie Kiwi. This did put in a very wick-like candle right here. Is this a reversal? We'll see, but it has had a pretty consistent bearing going since we bottomed out there back in later January. The last thing we're going to look at, a commodity update, gold. These are the perfect opportunities for gold recently. We've had instability in the emerging markets. We'd had risk aversion. We'd had a pullback in the U.S. dollar. And this commodity is struggling. Right? Take that into consideration. Doesn't mean it can't go up. But if it can't go up on bullish, what is bullish data for the metal itself, then what does it stand a chance going forward should the conditions start to deteriorate, such as a big, healthy demand for the U.S. dollar? Keep that in mind. All right, we'll wrap it up here, and tomorrow we will cover in depth the BOE and ECB rate decisions because those have great potential for the euro and the pound. Good luck trading out there, guys, and I'll talk to you once again tomorrow.